Hey everyone, welcome. Have you ever wondered what people actually mean when they say they're investing in a company? Well, today we are going to break it all down. We're talking about stocks, what they are, how they work, and honestly, why they're such a huge deal. Let's dive right in. I mean, you've totally seen this online, right? You're scrolling through your feed and you see posts about buying the dip or someone going all in on a hot company like Tesla. But what are they actually doing? When someone says they're investing in a company, what they're really doing is buying its stock. So, what on earth does that actually mean? Okay, to really get a grip on this, let's use a simple and kind of delicious analogy. Imagine you're owning a slice of cake. So, at its core, a stock is just a share of ownership in a company. That's it. When you buy even one share, you're not just buying a number on a screen. You are literally becoming a part owner of that business. How cool is that? Let's stick with this cake thing. Picture your favorite company. Let's say it's a giant chocolate cake. Now imagine that cake is cut into millions and millions of tiny little slices. Well, each one of those slices, that's a share of stock. So when you buy one, you're basically saying, yep, I'll take that piece of the company. Thank you very much. Okay, so that brings up a really good question, right? Why in the world would a company, especially a successful one, want to sell off little pieces of itself to just anyone? Well, the biggest reason is pretty simple. They need to raise money. In the finance world, they call it capital. See, companies need cash to grow. Maybe they want to fund a new factory or develop some crazy new product or expand into other countries. Instead of going to a bank and getting a loan, they can just sell off these little pieces, these shares. And the best part for them, that money they get is theirs to keep and plow right back into growing the business. So to see how this whole capital raising thing works in practice, let's walk through a little story. Let's talk about a made-up company we'll call Fresh Kicks. Okay, so meet Maya. Maya has this awesome idea for a sneaker store, Fresh Kicks, that sells all the cool limited edition stuff. She's got the brand, she's got the vision. What she doesn't have is all the cash she needs to get started. She's crunched the numbers, and her business plan says she needs $100,000 just to get the doors open. That's the capital she's got to find. So instead of hitting up a bank for a loan, she gets creative. She decides to divide her new company into 10 equal shares. Then she decides she's going to sell 5 of those shares to raise money. And that's where her friend Jordan comes in. He's a total sneakerhead, he believes in Maya's vision, and he wants in. He decides to invest. So Jordan buys one of those shares for $10,000. And just like that, he now officially owns 10% of the entire Fresh Kicks business. It's a win-win, right? Maya gets some of the cash she needs, and Jordan gets to be a part owner, making a bet that her business is going to be a huge success. Okay, let's hit the fast forward button. We're 5 years down the road. And guess what? Maya's bet totally paid off. Fresh Kicks is a massive hit. The business has grown way, way beyond what it was worth at the very beginning. In fact, that company that started out being worth $100,000, it's now valued at a whopping $300,000. This is a perfect example of the power of investing in a growing business. So what does this mean for our friend Jordan? Remember, he put in $10,000 for his 10% slice of the company. Well, his 10% share is now worth $30,000. If he decides to sell it, he's made a $20,000 profit. Not a bad return on his investment, huh? But of course, investing isn't always a happy story like that. There's always a flip side, and it's really important to remember this. What would have happened if Fresh Kicks struggled? Let's imagine a different scenario. Let's say the competition was just too tough, and the business value actually dropped to $80,000. Well, in that case, Jordan's 10% share would only be worth $8,000. He would have lost $2,000. So here's the absolute key takeaway. The value of your stock is tied directly to the success or failure of the company. Okay, so we get what a stock is, and we definitely get the risks and rewards. The next logical question is, where do you actually go to buy and sell these little pieces of companies? Well, you go to a place called a stock exchange, and you can really just think of it like a giant, super organized marketplace. But, instead of people selling fruits and vegetables, they're buying and selling shares of ownership in some of the world's biggest companies. You've probably heard of the big ones, like the New York Stock Exchange or the NASDAQ. But here's the thing. You don't have to fly to New York and walk onto a trading floor. These days, almost everybody does their buying and selling right from their phone, just using simple investing apps. All right, something else you should know is that not all stocks are the same. A great way to think about it is like concert tickets. You've got your regular seats, and then you've got the fancy VIP passes. The two main types you'll hear about are common stock and preferred stock. Common stock? That's your regular ticket. With these, you actually get voting rights, which means you get a tiny say in big company decisions. This is where you find the highest potential for growth, but it's also where you find the highest risk. Then you have preferred stock. Think of this as the VIP pass. You usually don't get to vote, but in exchange, you get guaranteed fixed payments called dividends. A dividend is just a portion of the company's profits that they pay out to you. So it's lower risk, but that usually means it has lower growth potential too. And all of this really brings us to the final and probably the most important question of all. How do you balance the risk with the reward? I mean, really, why would anyone put their hard-earned money on what can feel like a total roller coaster when a simple savings account at the bank is, perfectly safe? Well, the answer in one word is growth, or at least the potential for it. See, while a bank might give you maybe 1 or 2% interest a year, the stock market, historically, has returned an average of about 7 to 10% annually, if you're looking at the long term. That higher potential reward is exactly why people are willing to take on the higher risk. So, what's the big takeaway from all this? When you buy a stock, you're not just playing a numbers game. You are buying a small piece of a real, living, breathing business. Its success becomes your success. But you've got to remember the oldest piece of advice in investing, and it's famous for a reason: don't put all your eggs in one basket. Spreading your investments around is absolutely key. So, I'll just leave you with this thought. Now that you know you're not just buying a stock, but a piece of the future, which future are you willing to bet on?